everybody. How are you? Welcome from Mortgage Pros 411. I am Audrey Boissonou and my co-host Kevin Casey, and we are joined today by the lovely and smart Tracey King, COO of Partners Credit. Thank you so much for being here, Tracey. How are you?
Thanks for having me again. Good.
Good. All right, before we dive into the meat of it, I want to make a few announcements. So we have events going on around let's go with, we have events going on. How about that? There are events going on. That's a much better way to put it. First of all, they're both on Thursday, February 16th. There is one in Rancho Cucamonga, and it is the Inland Empire Camp chapter, and they're putting on How Do You ADU? Isn't that cute? How do you ADU? ADU, get it? Accessory dwelling units. Yeah, so they're going to teach. It's everything about ADU. So anyway, it's in Rancho.
And is that one you have to be there live, or is it in person?
It is live from 11:30 to 1 p.m. in Rancho Cucamonga. That's why I've said the name of the town 3 times, because it's there. So with that being said,
that's one of my favorite city names in California too. I just like to say it. So you should say it a 4th and a 5th time. It's in Rancho Cucamonga.
Cucamonga. I know. I'm gonna have to go there next time I'm down, see what it looks like. So anyway, if you are around, and people, it takes a lot of energy to put on these events. Please show up for them. I'm hearing from different chapters around the country, and we're seeing it everywhere too. It's, getting people to get out of their houses is hard, but that's how you, interact with humans and learn new things and meet new people and develop relationships. And that's all.
To find out what's working for some loan officers, it's not working for you.
That's right.
Oh, wait, I'm tapped into this and it's working really well.
That's right. And there are people doing business, so be one of them. Okay, the next up, Kevin and I are both going to be there on Thursday night or afternoon-ish, 5:30 to 7 in Daly City, which is adjacent to San Francisco, and is Jeff Zimper. And he wrote the book Disrupt or Die. We have talked about it a few times. It is a really, again, if I can get through a book about, marketing and social media, anyone can get through this book. It's so really well written and entertaining, but also really good points on what to do, when to do it, how to do it, So he will be there live. Join us, please. It'd be super fun to meet you. So with that, and Kevin, is there another flyer going out at some point on that?
There's probably another flyer going out one more time.
Okay, that sounds great. All right, and maybe if someone could throw a link into the chat, that'd be awesome. Don't ask me to do it. All right. So, okay, there we go. Niceties aside. There's also a request from FHA for input on the 203K program. So I'm going to send that. It will be embedded in the recording on YouTube. If you would like to participate with FHA as far as making the 203K process better, then definitely look for that, and we'll put that link in there. Oh, and also, by the way, happy Valentine's Day. I just love being able to spend it with you. Tracey, it's nice that you wore red today. I should have thought of that, but I did not. So
it was this or black, so I was trying to be a little festive.
Oh, that's nice. I went with black. I'm in deep mourning. It was snowing here this morning, actually.
Oh, wow.
I know. All right. And then finally, thank you to Jason Bellevue, Ben Bellevue, and Gina Pasquini with Social RX. They really help us get all of this together. It's so, we couldn't do it without them. And we just want to make sure that we're letting you know that we're not doing this ourselves. So let's talk about credit for a minute, shall we?
Let's do it.
Tracey. So
actually, yeah, let's refresh what happened last time she was on the show.
Okay, why don't you do that, Kevin?
It's like
let's see if we agree with his version of what happened, Tracey.
Right,
that our credit reports are going to be jumping to $100 per report or something like that. And sure enough, that happened right off the bat. That was the first place that I heard of it, was from Tracey. And then we also learned about how to keep all the creditors from preying on your clients when you pull their credit scores. So that was very valuable information, how to use the Optout pre-screen to our advantage. So just want to remind everybody that these were like really great tips last time.
And honestly, the opt-out stuff, I can't tell you how many questions I get and field those questions on a day-to-day basis. I understand LOs are getting a lot of negative feedback from their borrowers of why did you do this to me? And there's
Why
just,
did you do this? I get that. Why did you
Yeah.
do this to me? I had one client complain. He said, I'm running a business and my cell phone is blowing up with people calling me to or to take my loan. And why did you give them my phone number?
Yeah, and it's really, you know, it's borderline harassment, if not it is harassment. I mean, the way that people feel bombarded, and especially those that, you know, depending on how savvy you are about this, it's key also, you all know that it's going to happen. The conversations you have with your borrowers are essential of, you know, rather than kind of playing it on the end and, you know, hopefully it'll die down for this borrower. It's not, it's just seemingly getting worse and worse because people are buying more and more leads because they're desperate.
They're desperate.
So, not only working with realtors that you're working with to try to, you know, have the borrowers opt out as early in the process as possible before it comes across your desk to pull their credit. Make sure you're having those conversations with the borrower. Tell them it's about to happen, what to expect, how, you know, you don't need to answer it. A lot of times you know, I went through a refi and I actually kind of played around with it because I knew that I was kind of like, oh, I can kind of research what I talk about a little bit and talk to different size lenders to see what would happen. And I can't tell you the amount of like bait and switch, the way that people are trying to grab your attention and make it seem one way. And then actually when you talk to them and get it lined out, it's like, yeah, no, it's exactly what my previous lender was telling me. You just kind of phrased it in a different way or try to make something shine and you're putting it on the back end. So those conversations with people go a long, long way. Not everyone is savvy about this like you are. They're not used to it. It's a huge change in their life and you know, break it down like you're talking to a kindergartner. I think that's the best way. Yeah.
Well, you know, it's worse is some of them, like the story, some of both Audrey and I know that was a loan officer and got a call when she was doing her own refinance, you know, not her own personal, but through her own company. And they called her and said, yeah, your lender called and said your loan was declined, but referred me to you.
Yeah. And it was her loan.
Yeah.
So she knew it wasn't true, but can you imagine? And then, okay, look at this. Just this morning, I saw this on Facebook. It was a text that someone had received. Hey, so-and-so, this is Mike, partnered with TransUnion. Your profile was referred to me from your recent mortgage inquiry. And since we are currently one of the premier lenders in the country, it gives me the ability to beat any lender in rate and cost by at least half a point. I quote over text without pulling credit or needing sensitive information. Are you looking to refinance or purchase? So is that even legal to say that you're partnered with TransUnion? What does that even mean? Not to mention that he's promising things he doesn't even know if he can deliver. I mean, you know what I mean? I can beat.
Well, and you can't refi without pulling their credit. I mean, that's just misinformation. I'm surprised by the kind of marketing that's out there. I mean, to this day, I've been getting something from the way that they present it is from who pulled my credit originally and who I went through my refi with. It's coming to look like it's from them.
From them, yeah.
Sometimes it looks like it's a check. Sometimes it says, hey, your warranty is about to end, contact us. And nowhere does it say who that company is. I just keep seeing the lender I used. And it's like, you just think of all these borrowers out there that are not savvy and will probably freak out about this and go back to their lender. So, you know, it actually might behoove the lender for all this because the borrower is probably confused and goes back to them and says, hey, do I need to do something here? But yeah, it's of all the regulations we have to go through, how this is not top of line. And to go back to the opting out, I know a lot of people, it's kind of like, who's going to fix this? Who's going to fix this? It's really important for everyone to kind of get involved with state legislature and try to have, you know, talk to your local MBA, talk to whomever to start to push these kind of action items, because I honestly don't think that anything's going to change until we start doing it at like a state by state basis.
That may be true. We at NAM, National Association of Mortgage Brokers, last year and another time previously have dropped bills to limit trigger leads. So, you know, different ways to go about doing opting in versus opting out, so that you're saying you want to receive trigger leads instead of getting them unless you say you don't. Different variations, and it's a tough hill to climb. And these credit bureaus have so
money.
many of the people in charge convinced that this gives the borrowers more choices.
Yep.
They don't understand how fraudulent it is and how misleading and confusing. And so it is up to us at both the state and national level to, you're absolutely right. It's going to have to be legislated because there's
Yeah.
no way. I mean, they have too much money involved. You know, there's
Catfishing doesn't just happen on dating apps. It happens in our industry too.
But I like your idea though, because I know it's probably going to be one of the topics when we go to DC in April, when we go talking to the legislators, because it was that was there last year. We had the bill dropped, so it is an active bill that NAM is pushing to block it, but so far not getting any traction. And I'm kind of thinking maybe we need to go at the state level, like you said, and that one of those things like California might take the lead on.
Yeah, that'd be
And
something.
And somehow being able to compile, it's impossible to compile that data unless it shows who the bureaus sold the data to and how they're using it. They're the kind of the key to it, because otherwise, who's going to be able to go out and say to your borrower, can you show me every single call, email, text you received? It's huge, because then it's just like you as a loan officer going up against the FTC. It's not going to work. So they have to
just
think smaller, bigger.
The bureaus get paid when they sell your information. Then they also get paid again when you've got multiple people running more credit reports. I mean, talk about double ending something, right? It's a bunch of hooey. That is for sure. Okay, so explain once again, because we cannot hear this enough. And to people who have heard this before, you're going to hear it again because we forget. We need to be reminded. It's really important to keep this top of mind for all of us. And so, how do people help their clients opt out? What do they do?
Right. So there's
timing.
Yeah. So it takes about 3 to 5 days to take place. So there's either a phone number, and we can drop that in the chat at some point, a phone number or the opt-out pre-screen website.
Yeah.
Yep. And they can just go in, and it's very simple. I've done it myself. Go in, put their name and information in, and that should stop it. Now, the misconception about this too is a lot of people come to me after the fact. If you've already pulled it, it's already been sold, it'll already happen. It'll prevent it from the next time you have to pull credit. But so what I suggested before is all of you are working with lead services or realtors that are helping funnel clients your way. Talk to them and have that as a value add to what you give them. Make sure they have that information and have them, give you a little prop about it of, hey, I work with this great loan officer who really is looking out for your best benefit and wants to make sure you get the best deal and not be bombarded by all this. It's all how you educate them, but they don't know until it's too late.
Not putting the phone number on your application doesn't stop the phone calls.
It does not.
And also putting in an incorrect phone number doesn't stop the phone calls.
It doesn't, because it's the data we push to the bureaus. The only data that we push to the bureaus is name, social security number, date of birth, and address. We do not even have a way to provide them that. That's something that they already have. They've got all your information.
Then why on earth is it required to run a freaking credit report?
That might be an LOS thing. It's not required by us. So,
how interesting. How interesting. And so the idea of putting the CFPB complaint line in as their phone number, that
that's a great idea.
I know, right?
I mean, if that happens enough, but yeah.
We were talking recently about the number of complaints the CFPB has gotten. It has risen exponentially in the last year, and most of them are around credit reports. Can you believe that? I mean, a big, huge chunk of them. You'd think they're all whining about their mortgages. No, it's mortgages, but really the credit report. So anyway, I mean, the consumers are figuring out the CFPB, and you just don't want to be the purpose of their call, right? So anyway, but yeah, I kind of like that idea a lot. Okay, so going right to the next favorite topic, how about those fees? I mean, what's going on out there? So like Kevin said, last time we talked about it, they were coming and we were like, holy crap. And there were the 3 tiers. And now it's all rolled out. Everyone's had their fee increase. How's it working? What's going on? What are you seeing from your perspective?
A lot. And I think that's because people kind of heard of it and they knew or assumed corporate was taking care of it. And now they're seeing their invoices for the first time. So, you know, when we started making announcements about this, there's a lot of influx of activity that we've had with our own customers and then from potential customers that are shopping around now, because it's like, okay, we put this off for so long, let's see what someone else has, or if you're getting the same pricing. So like you said, Audrey, there are 3 tiers, and I think there's been a lot of misinformation that's come out about this as well. It has nothing to do with your credit provider or the size and scale that they do. It is all about this mystery list that FICO delivered to the bureaus of what companies had a certain pricing structure. So the first tier had a 10% increase, and the third tier had a 400% increase. So
the not so secret list.
The not so secret list, yes.
So
So
100%.
And how many people in the first year?
it was between, I think it's like 42, I believe. I might be off, or it's like 38, 42. The second only had 6 or 8. And then the third's everybody else. So there's been some challenges with it. I think people were, you know, it's a lot of back and forth of people shopping and comparing pricing. It's all very challenging and difficult because I think a lot of people are just kind of having credit reporting agencies fight up against each other. But what we have done and what we suggest for everybody is not only are you looking at, okay, it is a good time to kind of shop around, see what other people are offering, but looking internally at your processes, making sure, you know, what are you ordering? When are you ordering it? And are you sure that you need it? A lot of times people call this a different word, like a refresh report or a pre-close report, or, you know, anything like this that are tacking onto your bill. The biggest thing also of recognizing within this is it's not just the credit reports. It's also when you reissue it, there's a secondary use fee. Those secondary use fees have also gone up. So before our secondary use fee, it was $6 and $12. So individual joint, they're now almost $16 and $32, depending on whether, so if you bundle that pricing, that's why you saw the pricing go up even more. And because it all is considered into that, the bureaus charge that secondary use fee. So there's a lot going on in there. And I think that with that on top of the work number increases, which we can kind of talk about that, people are having a huge sticker shock this month. And after everyone got their invoices, our phones started ringing quite a bit, even though we tried to give as much communication as possible. It's what do we do now? And it's no longer, can you give it to me for cheaper? Our hands are tied at a certain point. You know, we have to operate a business. We're not trying to do huge margins. There was never huge margins on credit, but now it's really having thoughtful conversations with your vendors. And I would never kind of come and say only partners, my company would be the one to talk to. I'm happy to do that. But for the interest of everyone listening, it's not just about lowering your prices, it's about your process. So I encourage all of you to talk to your vendors about that process and working with them to see how you can better it.
Now, I've heard rumors that there's some companies out there that are giving their breaks to loan officers if they run the credit through their company.
If you're talking about one of our favorite brokers out there, the broker shops, yes, that came out, and there has been huge pushback from that. So essentially, United Wholesale came out and said, because they're listed in the top tier,
right?
I'm giving out too many secrets here. They're listed in the top tier.
We know these things, like it's out there, right?
Right. So they're listed in the top tier. However, the way that this was supposed to work is, you know, it was United Wholesale that got the cut, not their brokers. So United Wholesale came through and said, okay, well, if you come and sign a contract through us and pull the credit through us, you can get this cheaper price. So it's not as easy as it sounds. They have to kind of sign up a certain way. And then FICO and the bureaus got wind of this And through
Oh.
all of our communication with them, made it sound like that this was not okay
Oh,
and that they shouldn't be doing it that way. Now, whether or not they are up to the challenge of Matt Ishbia, that is the next, and we're waiting to see.
You think Matt's gonna take on the credit bureaus?
I mean,
my God, that would be, I would pop some popcorn for that one. That would be one to watch, right?
I mean, he probably dreams of something like that. So yeah, if there was anyone to do it, it would be him. And we'll see. And then Rocket had something where they said their credit reports were for free. Now, how they're making up on that and how they're handling that, again, there's a lot of gray area that to us seems like, no, it should be black and white, but I think they've found some kind of gray area to go about it. But I would not be surprised if it's short-lived. Or I guess I also wouldn't be surprised if the bureaus don't push it too hard. It's, that's hard to say.
Well, so, okay.
I
So
know.
I don't even know where to start.
It's all kind of deflating, but we're going to stay positive and look for solutions. Yeah.
Well, so to be clear, I just want to make sure people understand, these were not the credit. This was not Partners Credit going, we're gonna make some more money. This was literally FICO, coming from FICO, right?
Yeah.
And then, okay.
Yeah. So, I mean, that's specifically that. Everyone received these kind of increases. Every year, credit reporting agencies receive increases. Typically, it's from the bureaus and FICO. Then you'll get all your other third-party vendors along with that. It's usually like, there's been a couple years when trended data came out, we saw a big bump then, but it's usually within $1, 50 cents, 15 cents. This time it came through and it was FICO who, we usually have an increase from, but nothing like this. And so you're getting the FICO increase on top of the bureau increases. So theirs aren't as significant as FICO, but that was also a part of it as well.
Gotcha. So are you able to, we have a question from someone, can you share what some of those ideas are for how to save money if you're a broker or an LO?
Yeah, so it's really, like I said before, it's looking at the process. And I'll say this, that part of what we did as a company was we didn't just reach out to our customers to tell them about the increase. We tried to tell them different solutions. So there's a few. There's auto upgrade, which we call, other people call it cascading. Right now, we know the borrowers aren't as vanilla as they used to be. So why are you pulling a tri-merge on every credit report? So your vendor can probably set limitations on your credit report. So if the score is beneath a certain threshold, if there's a bankruptcy or different attributes on the credit report, you can stop that at a single or two bureau score, so that the bulk of the price is typically once you hit the tri-merge, because many of your companies have it as a bundled price. So stopping it at two bureaus and looking at it and saying, is a 620 viable for what we can do right now? Are they still shopping? But we know where they are and what they can do. That's a solution that you're going to have a small percent, decrease in your invoicing. But the other option that you would have is something that we're kind of calling an enhanced credit bundle or closed loan pricing. And with that, we're essentially bringing down the upfront cost. We're looking at all the credit reports you pull. So for most lenders, out of 100 credit reports you pull, especially in this climate, 20, maybe to 25 are going to the closing table. So before it was, a lot of money you're paying out for credit reports, but we weren't feeling it as much because we were getting so much money elsewhere. Now, if your credit report's $100 and 80 of those you're not able to recoup in any kind of way, that is a huge expense, Huge. It's between us probably in your LOS systems that are the most expensive. So let's try to think about this differently. What if we bring down that upfront cost? What if we look at that and reduce it down to a small level where we're basically in the red? And then we look at your loan process and what is a milestone that you're achieving in which you know that from this point on, you've pretty much secured that loan. There might be a small drop off. So once you pull your flood report, if you're pulling an LQI or a pre-closed refresh report at the end, a fraud report, once you pull that, it triggers a secondary fee. So let's pretend if you're credit report used to be $100. Let's bring it down to 50. But once you hit this trigger, the loan's going to close, then we're going to put $75 on top of that so that we're able to recover the fees and you're able to transfer that over to the borrower. So you're recouping it on the closed loans and bringing down your upfront costs. So I would say out of our top 10 customers, 8 of them have moved to this model.
Interesting.
So you're literally partnering with your clients.
That's
Did
the goal.
you get
That's
that?
the goal.
Did you get that?
Yeah,
Okay.
I got that. That was a good one.
Okay,
Yeah.
just want
I
to
mean-
clarify, just in case it wasn't as funny to somebody else as it was to me.
Right, no.
Okay, so so we have a question here. Can you state again, confirm, if a client completes both the optoutscreen.com and the do not call.gov before the credit is pulled, that their info will not generate a trigger lead? Just want to be sure, since removing the phone number doesn't work.
Oh, well, yes, I can confirm it. I can't confirm how many days it takes. Like I
Okay.
said, it can typically take 3 to 5 days. That's what has been published. I believe that's what they say on the website. So it's not like they did it an hour ago and it's not going to happen.
And I'm
Right.
assuming those are business days, not weekends.
I can't confirm that, Kevin. I do not know.
Let's worst case scenario, shall we? Okay, it's business days, also holidays, also any other random thing that they might throw in there just for the fun of it. So give
We're
yourself
not
a little
shutting down,
time.
kind of
Like,
thing.
don't screech into the finish line going, I'm gonna run a credit report.
Well,
Can I do it for
it's all automated, right? It's digitalized. So why it's not like there's a human answering the call. Let me type it in and fax it over to Audrey in California, who will snail mail it back to me. Why it takes that long, I have no idea.
It'd be
But
automatic. I mean, it really should.
That's so cute. Are you looking for logic in this process? Is that what you're looking for?
why would
Come
I
on,
ever
people.
dare to
Come
do that?
on. We know that's not gonna happen. Okay. So yeah, so make sure you're opting out, make sure you're doing the, all of that, because it really does impact things.
It's
easy
really
to forget.
simple. Yeah, no, it's really
Really.
simple. Ever since Tracy was on last time, I've had all my clients do it.
Good.
And I've noticed that they're not complaining so much about the phone calls.
Yeah, still there though, still there,
Yep.
but yeah.
Okay, somebody's asking, we're gonna do this really quick, but can you please explain the enhanced upfront credit package again?
Okay, so it's funny, we talk about this. LOs are so creative in ways in which you're going out and trying to get new customers and do everything. And yet sometimes we can be so stuck in our ways about everything else because it's just the way that we've always done it. So it's trying to you have to kind of wrap your head around this a little bit differently. Essentially, you're paying a lower cost of your credit report. Your credit reporting agency is going to take a hit on that. Obviously, they need to recover it. But the understanding is that you're not able to pass along fees to someone that doesn't exist or go to your closing table. So we're going to pull the fees that we lost on the front end to the back end once you hit a milestone in which you're going to close. And we're going to enhance that fee at that moment. So if it's a flood report and you normally pay $12, it's going to jack that price up to a higher price to recoup for kind of all the reports that we lost along the way. So your invoicing is pretty much going to look the same. There's not going to be a difference on your bottom line invoice because we obviously have to pay for the reports ourselves and the FICO scores and all of that. Where this comes for you is on your P&L. It's looking at, you're still paying it, but how much did you recoup from the borrowers? So a lot of times people will say, well, how can I tell my, they ask what the hurdles may be. Some people are asking, how can I list my credit report cost as $150 when ACB or ABC lender down the street just has them for $100? Well, it's dependent on what you're including in that bundle. You can list it as a credit verification bundle. Some people have compliance concerns about that, of what you're disclosing, but the disclosure will always be the same. It will never vary because it's a set cost. You're including whatever you want in that. It's fluid and you can kind of work with your credit reporting agency to what it includes. But it's all about how you present it. So it's, you're recouping costs on a borrower. It's not as if you're charging different borrowers differently. If you're not charging a borrower on the upfront credit report, this wouldn't be an issue. And you just kind of tie it in at the end. So it's a one bundle fee. So you're recovering that. If it doesn't close, the broker pays the back end fees.
So that's a really, the compliance issue is really important one, actually, now that you say that, because we know that the CFPB has come in and done audits and been unhappy if you don't have, you know, the flood insurance fee outlined by itself and who it was paid for and for how much and all that. So make sure you're talking to your compliance people and making sure that you're being compliant with however you're going to disclose this, so it's done correctly. Okay.
Yes.
And remember, I cannot say this enough. Well, maybe you guys think I say it enough. It can't be said enough. Make sure that you're not depending on your wholesalers who are sending out disclosures for you to make sure it's correct. Don't assume that they're doing it correct, because everyone has an interpretation. And ultimately, if somebody gets in trouble for something, it's you, it's not them. If those disclosures are wrong, it's you. So don't forget that. I know I sound like a, you know.
Well, and I'm pretty sure that CFPB is not going to consider the fact that the loan is now going to closing a change of circumstance that you can now charge the extra fee on the credit.
That's actually a great question, right? Okay, now confirmed loan is going to close. Is that a change of circumstance? I'm literally going to call and ask.
Right. But it's always the fee. So this might be challenging for brokers depending on what products you guys are actually ordering. So I know a lot of times brokers aren't including verification fees or whatnot, but so that might be challenging for the broker. But yeah, as a lender, you should be able to work something out, and it can be, I mean, you can go as crazy or wild as you want. If you just want to bring down that fee a little bit, you should be able to work with them to have a conversation of what that looks like. It's really how much money do you need to save in this moment. If you want to drive down those upfront costs, you can pretty much bring them down to virtually nothing, but then expect a huge kind of back end pricing, or you can kind of modify it so it meets in the middle.
You know what I'm going to see is, I bet more brokers are now going to be charging upfront for credit reports when a lot of them had backed off of doing that.
I think it's too much now. I think that no one is willing to pay $100 with their credit card when they're just starting something. I mean, it's different if it's like, hey, I'll pull your credits, it's going to be $30, whatever. $100, you know, people are going to really question that, especially if they're wanting to shop around and they're not fully committed. So the other thing I'll bring up that is kind of coming in the future, which I think will be interesting, is we've talked before about prequal reports as a way to kind of offset those trigger leads as well. Currently with prequals, I have a love-hate with them. I don't see so much of a benefit at the moment because I don't think loan officers are using it properly, and it's just another fee added on to your total. The benefits of them is that you pull a prequal, you can still have scores. It's a different kind of pull, but you can't reissue it. You can't see any kind of findings. You can't, you know, what are you going to do with it? You can't give a firm offer of credit from it either, but it kind of shows you where that borrower is. Right now, Fannie has a pilot going on where they're going to make a prequal report reissuable. And that is something that if you're interested in, you can talk to your Fannie provider or your rep, and they can kind of walk you through that. But the only thing I'll say about that is if you can reissue it and the LO has a good idea of what this loan can do, that will be cheaper than a credit report. It's going to still be a little bit more expensive because again, the FICO stuff, it'll be in there, but that can be a solution down the line when we're looking at all these fees and we start rethinking, you know, what's the first thing your LOs do after they pull credit? A lot of them are reissuing them before they know what they're going to do because they want to be able to tell something, you know, immediate to the borrower. This will help with that and help drive down those costs, I think, but that seems like it's a while away.
How much are those approximately, or does it vary?
It varies. Typically people don't do a tri-merge of them. They do like 1 or 2 bureaus, and that can be kind of $3 to $4 a bureau.
That's a
So
lot more.
That's
That's a lot more palatable than,
Yeah.
and what do those reports miss, if anything? And why aren't they reissuable, for goodness sake?
Everything has
And
to
by
have
the way,
special
if you can
permit.
do that crap for $3 or $4, why the hell is a credit report $100+ now? What? Okay, so many questions. Go.
Yeah. I wish I had the answers, everything's behind this, what is it called? Curtain that we don't
Yeah.
know about, but, so it has everything that a credit report has. It has everything that a credit report has. It has the exact same score that a credit report has that you would pull, but everything falls under different coding and different permissible purpose. So the one thing I will say with that is that there are heavy restrictions. You have to sign a separate addendum to be signed up to pull a pre-qual report. And they're very, very specific on how you're retrieving that authorization. So one of the bureaus, you can't just get a verbal and notate it. It has to be recorded, or something has to be in writing. They're good if you're using like a POS system that automatically kind of retrieves that and you can store it. But again, everything sounds good. When pre-quals came out, everyone was hot and heavy about it, until you get again to the fine print and realize that it's actually it puts a lot of onus on the lenders to make sure you're following it and tracking it and people are utilizing it the correct way. I think it's really good if you're working with a builder and you're working with the borrower earlier on. That's a great way to start to kind of see even if they're viable. Otherwise, if someone's walking in your door and you're pulling that credit and you're trying to hold on to them, that's where things get a little tricky.
I'm just flabbergasted that there's such a disparity between that cost and a credit report cost. And I just feel like that sounds really attractive to me. Like, just pull that to begin with. You just want to know, I mean, is it a total, mess or not? And approximately what am I dealing with? And then it gives you I don't know. It just seems like that.
Someone just said that they did it now, and to their credit, they just said that they have them fill out. They get a soft close. Their closing ratio is 25, but it's a huge money saver. I mean, it's really big. It helps you know where you want to be, but you want to make sure that your LOs are doing it in a savvy way. It's very similar to kind of, what we were talking about with auto upgrade. Do you need to pull a tri-merge credit report? Even if you know that they're in a good score threshold, if you're not giving a firm offer in that moment,
Yeah, pre-qual might be better because they may not go into contract for 3 months.
Well, and so that's the other piece is there might not go into contract for 3 months. And also with that pre-qual, there are no triggers. The bureaus cannot sell that data. So that's the other
How is this
benefit.
not the solution? How? I don't get it. What am I missing? Like, why is this not awesome?
It's all about your process. That's it. It's kind of, I think people are used to doing a tri-merge, reissuing it, and giving an offer, right? Rather than, because it feels like everything is immediate. You need to give that to them today so that they don't walk away to somebody else. So the tools are there. It's just, how does it impact your process?
So it's the difference between being able to say they have DU approval or not, right? You can't say you have DU approval because you're not able to issue findings, right?
Yep.
Is that the bottom line?
Bottom line.
And Fannie's working on it.
Fannie's working on it. Now, how they're going to shift kind of the protocol with it, if they're able to reissue it, are they able to offer? I'm not sure how all that will work. And so
and when we heard Sandra Thompson speak in Washington, D.C. last year, I don't know, Kevin, if you remember this, but they had been working on some initiative, and someone asked how long, and how long is it going to be? How long had it been? 5 years they've been working on it. And so it's like, okay, can we get some sort of timeline on this thing? That'd be awesome. And again, do the math on the costs that are racking up for everyone. It's crazy in a time when we so don't need that, right?
Worst timing ever. It's painful. It is painful for, a lot of, depending on the size of your company, the increase is a salaried position for the year of what it was comparable to last year. And it's when everyone's already making those horrible decisions of having to cut people, but it's just,
it's also I think it's also one of the reasons a lot of companies are seeing a lot of mergers now, in addition to just the market. But if you're one of the companies that's not one of the 42, if you merge one of the companies that's in the 42, now you've just saved a fortune in credit costs.
Yeah, and honestly,
That's
like my
interesting.
biggest, it's so unfair in so many ways. The fact that these tiers exist. My biggest frustration when we were talking about the CFPB is how they kind of put their hands up and said, this is on the bureaus, this doesn't have anything to us and the consumer, but yet it does, because the consumers that are going to be feeling this, or the impact for them, is going to be those smaller community banks, credit unions, lenders that are seeing to these communities. And a lot of times it's minority or low income. And so you're forcing this upon these smaller institutions that cannot afford it. So how that it doesn't have a disparity in lending, I don't know, because if that makes the difference,
Completely does.
Yeah.
And especially if the biggest increase in their complaints is over credit reports, you would think that they would be, again, I'll ask. I mean, what happens? What happened? It's only me. It's no biggie. So I was talking to someone who had just spoken to Sandra Thompson, and they were asking her about these LOPA increases, which we'll get to in a little bit. And, they're really, the GSEs, Fannie and Freddie, are so focused on providing more affordable housing and doing this cross subsidy thing where you have the, supposedly more qualified people pay for the less qualified people. But then this just feels like it flies in the face of all that. If you're trying to make things more affordable, why is it so much less affordable? But okay. So talking about money, I want to talk about verifications, because this keeps coming up too. So I have a couple of questions around that. The first one is, have those fees gone up? And secondly, I keep wondering why somehow we've transitioned from going to someone's HR department, which I know had its own hair on it, but like just being able to go and get a verification of employment directly from an employer, then they pass that on to basically their employees. And I tell my borrowers, I'm like, look, your employer is choosing to use this verification process, which costs you money. So if you don't like it, talk to them, you know what I mean? But maybe that's not the best answer. And so anyway, so let's talk about verifications. How's that going? Both fees and just logistically, the numbers being correct on them, for instance.
Yeah. So verification of employment, that's the other huge bill that everybody's going to be gobsmacked by. And we've heard a lot of that. It is seemingly another monopoly in our industry. However, there are some different third-party vendors that are kind of coming into play. It's just a small process. And then it turns into the war of the two. So tips for your listeners, I guess, is the Work Number not only increased their pricing, they also changed the way in which they're providing the information. So previously it would be, you can select if you wanted previous or current employment. Now, no matter what, they are going to give you 36 months of data, whether it is current or past.
Wow.
And you don't have an option to not have one or the other. So again, let's throw out a fake number. It used to be $40. Now it's $50. I know there's a variance between the two. I think it's more like $55, but you don't have the option of, going through. Yes, you can't limit the time frame. It always is 36 months, and you can't limit what comes back. So it would be $110 if it's past and present. Their reasoning for it is that typically speaking, you need 24 months of current and previous employment. So why not give it all to you? Well, our question is, okay, well, why not cap it at 24? Why are you making it 36? Silence. Why can't that be an option? Silence. So there's a few things you as lenders can and should look at. Again, talking to your providers of. I would, rethink, or I'm trying to say this in a very polite way. If you are using solely the work number for your verification of employment, I would suggest looking to diversify that, because their manual process is just about as expensive as the institutions that have to use them. So not every workforce uses the work number, but they'll transfer it. If it's not in their database, they'll have one of their processors go out and make the phone call. 9 times out of 10, your credit reporting agency or a separate third-party vendor will do that for you for half that price. Many institutions, such as myself, will offer a cascade, which essentially there is another player in the game, and it's called Experian Verify. Experian Verify is working with a lot of different payroll companies. There are also day one certainty. So you have all of that included. We start there because it's the cheapest. We look at their database first to see if someone has to use them. We'll start there. Then we'll cascade down to the work number and check their system really quickly to see if the borrower's in there. If they are not, we pull it back, and then it waterfalls down to our internal processors. So if you're using a company that does your credit supplements, it'll be similar to that. I would make sure you talk to them about their policies and their service level agreements. There are a lot of these places out there that I have heard, maybe about the first party I was talking about, where it's like, once it goes to their manual process, we don't know what's going on. There's no feedback. It takes forever, and it costs just the same. A lot of places, we want to be competitive with the work number. We want to be able to kind of bring down those costs for you. So again, thinking about things differently, if you go into an exclusivity kind of contract with someone to do all of your VOEs, they probably will quote you lower on, you could do a flat price if they're guaranteed your manuals, to bring down your actual work number pricing as well, because we can make up that cost with the manuals, where they are going to charge you the same every time. So make sure you're looking at that invoicing, and also make sure you're watching your LOs and what they're ordering. If they're going direct to the work number, they're ordering stuff you do not need because they think it's like this enhanced package for $180. You do not need that. You need the basics, and you need to kind of look at how you're trickling that down.
Oh my God. Okay, so if my head's
Sorry,
about to explode,
that was a lot.
No. I'm not complaining. Well, kind of, but not about you at all. Because this is so complicated. Remember the good old days where you're like, how much is a credit report? $15. Great.
Yeah.
Okay, but, you know what I mean? And
Yeah.
now it's so complicated and so intertwined with all the verifications, and holy crap. And my eyes glaze over. And so I'm like that. Okay,
In our
it's
process,
a lot. But let me see if I can bottom line this. You tell me if I get it right.
Yep.
You really need to have a relationship with your provider. You need to be able to have good conversations with them about the best fit for their business and the most economical way to really serve their clients and get what they need. Correct?
Yes. Don't let your eyes glaze over. And I think that is, honestly, Audrey, you couldn't say it better, because I think we all do think it seems overwhelming in the moment. Looking at your options, people want to be able to provide this for you and can find a solution. It's a slight change. Changing credit providers, I get that's really difficult and challenging at times. It seems like it's disruptive.
Yeah.
Things like this should be a lot easier. This is the work number. A lot of these are automated, and it can really simplify it for you, and it can bring down those costs substantially. And that's all I hear about now is credit reporting price and the work number. So that's the
Right.
two huge things that you need to look at and make sure. I think people just would get those invoices, especially with the work number. It's like, well, we do verification of employment, but are you looking at it? Are you looking at how many are manual, how many they're doing on their own? What products you're actually ordering from them? A lot of times, if you're using a third party, such as myself, they'll restrict the products. So you're either getting, well, we could restrict some of it before, but now it's the past and present, and that's it. And I think someone asked a question, if you do a cascade, you will be charged for what it lands on. So if it lands on Experian Verify, you're charged for that. lands on the work number, you're charged with that. If it lands on our manual, you're charged that fee. So it can go from, you know, $48 down to 20. But that's the options. It's not that 55 every time.
Nice.
Okay, so, and just a little perspective, people, do you remember a year and a half ago or so when we went for 2 years or 500 years or whenever the hell it was, excuse me, where we went from paying $500 for credit report to like $2,000 sometimes, 1,200, whatever someone wanted to pull right out of their ear. Remember that? So, okay, so this is not great. We don't love it. However, perspective, it's, you know, it's a few $100. Now, I'm not minimizing it. I'm not, but I'm just trying to give us some hope and some lift for the future. There's a couple, I cannot believe how late it is. So I just want to run through a couple other things really
Fine.
quick. So just give me a second. So CPI came out this morning, not quite what they were hoping for, still better, but not quite as good better as they were hoping. So the rates are a little volatile right now. We know that they happened for a few days. They're
Not a little, a lot volatile.
all right, whatever. It's all relative, right? So the rates are all over the place. And so just keep your eye on the ball and stay the course. The rates are going to continue in a downward trajectory. It is not a straight line. It is never is, right? So, and they always go up faster than they come down. So just remember that we've got, and there's some tricky things around that CPI number this morning, and they keep changing the methodology, the way they're looking at some of these the components that go into consumer price index. Just Kevin always accuses me of not spelling out the acronyms. Consumer price index. And the feds love this measure of inflation, but bottom line is it did get a little better, not as much as they wanted it. And so there you are. The LOPAs. Here's another thank you. So I was sent this morning that grid that we talked about last week. Alan Kurth did that for us. It's not perfect. He says it may not be perfect. There are no guarantees. Do not take this and like, you know, hang your hat on it and stake your life on it. However, it is pretty close to perfect. I would say if not perfect, it gives you a sense of what the changes are. So I'll give it to Jason and he'll embed it in the YouTube channel so that you guys can access it there. So it gives you, you can look at it and go, okay, well, you know, at this I go and at this DTI, this is going to be the difference, or on this unit versus that unit, you know, 2 units versus 4 units, here's the difference. The other thing too is we really got verification this week from NBA and NAM, National Association of Mortgage Brokers, that their focus with the GSEs is to get rid of the DTI hit for any loans with a DTI over 40. That's the focus. The focus is not to get rid of all these LLPAs. I mean, again, the sense
Like
when you're
second
dealing
homes and stuff like that.
yeah, you're not going to get rid of everything. You got to choose your poison, right? And so again, thinking about LLPAs, can you imagine with the DTI thing, how often your DTI changes throughout a transaction? Yeah. The change of circumstances alone. Just think about that for a minute, what that would look like. Changes, I mean, anyway, so that is the focus. Make sure that if there is a call to action from anyone, we'll make sure that we let you know, and we'll make sure it's accessible to you. That's
from both NBA and NAM. We'll be sending out those.
Yeah, well, I don't know if they're doing calls to action, but if they do, we'll let you know. With that being said, you know, remember our business is cyclical. It always is. You got to stay on guard. You just got to watch what you're doing, and you got to think outside the box. There was an interesting study that Dan Habib, who we had on a few weeks ago, talked about, and it was from Pulse Atomics and Zillow. So they do this housing expectation survey, and this is good to share with your realtors and your borrowers. So they typically sample up to 150 of the top economists in the US. This time there were 117 who participated. It was for Q4 of 2022. So just last quarter, the home price appreciation or expectation survey. So it's saying in the next 5 years, what do they expect to happen with values? And the expectation is, you ready? Drum roll. Okay. 23.3% average appreciation is projected. That means that if you buy a $500,000 house today, you will have $115,000 in appreciation over the next 5 years. Guys, this is something that's important to share with your borrowers. And again, there are no guarantees. We know that. We know that the country it's not all the same everywhere. However, overall, if this is what we're looking at, we're going to be fine. So just hang on. We're almost through the first quarter too, which they projected to be total crap. Not them, but NBA did. And so in Q2 and it's spring season, it'll get better. And then also the same survey, they were looking at interest rates, and definitely it was unanimous. It sounded like that they had peaked and they were headed down over the next 2 years. So just something to, lull yourself or cry yourself to sleep with at night that will, make it seem like life is still worth living. It'll be fine, right? So anyway, okay, there was a couple of things. Let's see. I don't have a comment on the Biden advisors leaving today, but I'll definitely check into that. The book that we mentioned in the beginning was Disrupt or Die, written by Jeff Zimpher, and he will be in San Francisco or wherever it is, Daly City, on Thursday night, 30 in
the Lake Merced Golf Course, not Lake Merced itself, but the Lake Merced Golf Course, special, different club, and Daly City off of Junipero. And 5:30 to 7:30 on Thursday. Be there, be live, to show up.
I don't know what you just said. Something about Jasuna Becerra, Becerra, Valera or something. I don't know. And then just a reminder, and I have one more question for you, Tracy, before we wrap this up. I just want to get this in first. Just remember, we really appreciate your support in what we're doing. Kevin and I do this out of the goodness of our hearts. And it is really helpful when you share it with your friends, when you go to our register for the weekly Tuesday, this actually, and when you go to our YouTube channel and subscribe and view and send people there. So please do that. And if you have lenders, vendors, people who would like to support us, we would really appreciate it because it's expensive. So to finish up, one more thing, Cindy Ertman next week. I said it a couple of weeks ago, I was wrong. So Cindy Ertman actually is joining us next week. She is a nationally known and very well respected speaker, former loan officer with all sorts of pearls for us as far as making sure we stay the course through all this crazy. Okay, so Tracy, I just want to end on Vantage scores. We have a couple minutes. So let's talk about what's coming with that, the difference, tell us what we should know about that right now.
Yeah, I saw someone talking about how FICO is not how is it not a monopoly? Well, for a long time it kind of was. And then it was announced that Fannie and Freddie were finally going to allow for a different scoring model to come in, and that's Vantage score. And everyone got really excited. And they also said that they would only require 2 scores or 2 bureaus for the credit report. Again, everyone got really excited. But that is going to be a multi-year kind of unveiling of what
5 years.
like. Yeah, it's going to be a long time. So
because the Vantage scores, the ranges don't match.
Right. So there's 2 parts of it. It's matching what it looks like. If you can use one or the other, we're going to have a comprehension of what they look like next to each other. Positives of Vantage has stated, and again, I don't have a lot of access to them or haven't in the past because we've always had to do FICO through the bureaus, but what they are claiming is that the way that they score things will reach hundreds of thousands of other borrowers that might have been deemed unscorable through FICO. But again, being able to compare those, what those look like, will it be kind of like a dual score system for a while where you have both on there? Then you're going to have to pay for both. And how we kind of look at that, and how lenders and institutions, if there's no score as a FICO and they're deemed unscorable, how they're going to accept Vantage, a borrower with a Vantage score that in another way wasn't, how they're going to utilize it. So I wish I had a really great answer for this other than it's coming, and there's movement of change in a system that seemed like it was stuck on one course forever. So there is a positive side to it. I just don't know what it will be and when we'll get there. So that will take some time. But one thing that came up on the questions earlier, that when we first started, is talking about borrowers with no scores. I saw someone kind of ask about that, and I know people
Vantage would help
working-
that.
So glad you
Vantage-
did that. I was literally looking for it. I was just looking for
Yeah.
that comment. So yes, thank you.
So people were asking about like what they can do for a borrower with no score and how they can get them quickly added or to be able to be scoreable. So there's a couple of things that you can do and a couple differences between the bureaus, because why wouldn't there? And you know, it always has to be complicated. So Equifax and TransUnion requires one qualifying account that's reporting, and it has to be within the last 6 months of active reporting. Whereas Experian needs 2 qualifying accounts to be reported and at least 6 months of history. So they both need 6 months to be able to make that person scoreable. So my biggest suggestion, right away, have them open a credit card, keeping that limit low. Do not pay off that credit card every single month. That will hurt them. Have low balance on it. If they can, get them an authorized user. If they're younger and they have a parent that'll let them be an authorized user on their credit card, that will count as a qualifying account. But yeah, that's a 6-month process. So the other thing too, a lot of people ask us if you can add that via a score update, which you will have through your credit provider, and they cannot add accounts. So that's something that they have to make sure they're talking to the creditor to make sure the creditor is reporting that to the bureau. So again, being savvy with your borrowers and talking to them and communicating to them what that looks like. It's a simple phone call. They can call their Old Navy Visa and say, can you please make sure this is reporting to the bureaus? When will that be? And they have a special department that handles all of the bureau activity, and they should be able to push that forward for them. But that's,
You know, it's going to be funny with these LLPAs to see if we're going to want people to start driving their credit scores down a little bit so they don't have the big hits. Like you don't want to be a 780 at this point. It looks, we'll have to study the chart. So we'll get that to you. And again, thank you to
that's
Alan
so
for that.
wild. It's so wild.
that
Amount of credit
crazy?
makes sense.
Yeah.
I know. So
Yeah.
now we're going to be targeting what, 720 to 739, or I don't
Wow.
even know. I just pulled that out of my ear. People don't take that as the gospel truth. We'll see you. We'll see you next Tuesday at 11 a.m. Pacific. And Tracey King, Partners Credit, thank you so much.
Thank you,
If
Tracy.
anyone wants Tracey's information, let me know, and I'd be happy to pass it along. We adore you, and have a wonderful week, all. Bye.